unless you're a stacker and you're just buying your ounces, you got to really take a step back and say, do I want to hold through this? And the charts will really help you make that decision, right?
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers.
Hey everybody, welcome to the latest episode of Talking Trades from myself, Kevin Wadsworth, and my friend and business partner, Patrick Karim. So today we're going to talk about gold, and gold, of course, reached highs of just a little bit above $3,500 a little while back, and we've corrected the best part of $300 so far, and we were able to identify that this correction was the most likely scenario, the most likely path that was going to come next. And Patrick's just going to talk through now how it is that you can use technical analysis to give you an early heads up to expect this kind of correction. And if of course you want to do something about that and react to that, you can do. So Patrick, explain to everybody how we suspected this was coming.
All right, Kevin, thanks. Yes, of course, guys. It's never 100%, right? It's not binary, but it's always about establishing the probabilities, the odds of something happening. Understanding if you're on the sideline, is this a proper way to get in, right? Because when I did this chart there, I'm going to share my screen very shortly with you guys. I think it was April 16th. Oh my goodness. It was the bullish narratives. Gold repricing, gold reevaluated, gold standard, $10,000 gold, and it's all this euphoria talk. It's fine. Doesn't mean you're at a top, but it always brings you to the charts. Look at the evidence, guys. Just look where you are historically, and try to think objectively. Is it reasonable to think that this is just going to balloon like a banana shape, hockey stick all the way to the moon, like right now, that is always a possibility, but with charts, you're able to see the probabilities of that actually happening. So I'm going to share you right now. All right, guys. So this is a post I did back in April 16th, right? And all I said is, I know the gold bulls don't want to read this right now, but I just felt obligated, to do the devil's advocate and remind people that even during bull markets, some important corrections could happen along the way, right? In the 70s, it dropped 48%. And even in the 2000s, at the GFC crisis, it dropped 33%. And even recently there, in the current bull run that started back in June of 2019, we went sideways for 2 years and the price dropped 22%. How does this work? Okay, well, here's the gold chart. And I have the distance I have the 36-month moving average right there, the red line. And you see here, bull market in the 70s went down 48%, 65% here from peak to peak, right? But at the end of the bull market, I'll zoom in for you guys. Here you have the 2008 correction. And even sometimes, guys, you got to remember, a correction is price and or time. Here you see, I'll show you, if you bear with me before I show you my indicator, which helps me this. Here, the price didn't correct that much, just previous to that GFC correction, but the price corrected by time, by going sideways, right? This could be seen as opportunity cost. You could be going in another asset class, just letting that red line, that 36-month moving average catch up, right? That's critical. And here again, the 22% correction. So this one was price and time, right? 2 years of going nowhere. And even before it broke out, it took some time. So here we are today. Look at this crazy run. Before you guys get all upset, as long as you're above this inclining trend line, you're in an uptrend as defined by that angle. It's kind of steep, but it's a rising trend line, right? We have an equivalent trend line right here, right? As long as that is above, guys, you're fine. But even here, you're starting to be above, you're distancing yourself away from that rising trend line. Eventually, you should retag that rising trend line unless you really go even faster exponentially and that trend line gets more acute. You should expect some retests of it along the way of the bull market. But look here at visually, you should be able to see it. Like, that's a huge distance, guys, compared to here. You see the distance, how short it is here, medium here. You see how big that was? That's a lot of distance. So of course, all I have to do is I pop up my distance from 36-month moving average. So the bottom pane, guys, is telling me, all this here is telling me how far is the price away from that moving average? And you could do some classical TA on that. You could do some horizontal levels. Where's my next resistance levels? Where statistically are my outlier events? So here in the 70s, you had some crazy outlier events where gold stretched itself so much away from that moving average. Price was able to go bonkers, about 126% above its 36 moving average. And it did it again here at the peak of all peaks, the blow off top for gold. It was stretched, right? And emotions must have been crazy. And when it was up here, it must have been just bonkers. It must have been, I think the Barons had death of US equities. You can see some crazy stuff back then, right? All right, here's the bear market. Price coiled and tight, close to the moving average. Here you explode. Low risk entries, guys. When you're trending, you're starting to close above that 36-month moving average and you're starting to distance yourself away from it. That's what you want to ride. And look at this. Okay, it's corrected here. Here's the 2008 correction. But what's fun about these points now for us in being where we are today is we know that this is a resistance level, right? Resistance area. We know that even today, we were very close back in April. And now we see that as the price of gold has started correcting, it's starting to slow down its ascent towards that peak right here. So anything above this dashed line, and it's an area, right? I could have just moved it here, down a little bit. Anything above is areas susceptible of price going sideways, of letting the moving average catch up, price going down, catching up to the moving average faster. You'll see the bulk of the price, the time it stays is below that, right? All this, it's rarer that you stay above that. So that's how it's not foretold the correction. Now the correction's happening on the 4-hour chart, the daily chart, but it's still on the monthly chart. It's still intact, right? It's still above this rising trend line for momentum, right? Distance from that 36-month moving average. That's fine. As long as you stay above it, you're good, right? Here, I could have drawn another line right here, guys. It's when you close below that line, that's when the correction really you're starting to see it on the monthly chart. And that's kind of important because then you're talking about, do I want to stick around for 6 months, 8 months? Do I want to stick around for 2 years while that thing goes sideways? It's a good way to spot where the lowest entries are. So again, lowest entries down here on the way going up. But when you're stretched, when you're that far away, guys, I know it feels like everybody's talking about gold, central bank, a new standard, a global reset, death of the US dollar. I hear all those things. But from a trader's perspective, or even an investor, because this is the monthly chart, these are long-term trends. If you lose these rising trend lines on momentum, or you lose these rising trend lines on price, then unless you're a stacker and you're just buying your ounces, you got to really take a step back and say, do I want to hold through this? And the charts will really help you make that decision, right? Or if you're on the sidelines, do I want to jump in now in this FOMO? I'm afraid to move to $10,000. Well, look, the setup's just not there for that, right? Remember, if you miss the setup back in late 2023, or you miss a setup back in June of 2019, what could I tell you guys? You missed it. It's just, you have to accept it, and you have to wait for that next setup to morph into existence.
Yeah, exactly, Pat. Well said. And of course, when you combine that with things like the measured move having been reached, and combine it with the Fibonacci level suggesting that the Fibonacci extension has pretty much been reached as well, then you just combine all the evidence and you combine that distance from moving average data, and that helps you to make those calls that those medium-term targets have been reached. And you just, as Pat said, sit back, wait it out if you want to. You make your own decision based on what time frame you're trading on, of course. Okay, everybody, that's another nugget there from Pat myself at Northstar Badcharts. And if you like this content and you want more, don't forget to like, subscribe, and hit that notification bell. Bye-bye for now.